Why don't we start with gold? So gold is nearing all-time highs, along with Bitcoin. Funny enough, the two maxis are battling it out. What exactly does this mean? Typically, gold rising is a sign of deflation nearing. So that is a sign that we see. Uh, Typically, along with bonds, gold will also rise. So is this kind of like a canary in the coal mine that we're seeing? Like the market is starting to price in deflation nearing and growth slowing?
I wouldn't jump so quickly on that. I think okay, so we can't discount the fact that gold is up, right? That's like obvious. It closed at a record high today, so it's obviously doing good things. And I think the reason is like the market's getting an idea that the peak in real rates is in, right? So now some people might be like, okay, well, what are real rates? And it's simply the face value or face yield on a treasury minus the tip value on or the inflation expectations of a tip, and you get the real yield, so the yield after inflation. It's that simple. So on the left here or on this chart that I have pulled up, it's a simple chart. I have the real yields inverted on the left in orange, but we don't really need to look at the chart too much to understand what's going on. So all you guys really need to know is that real yields peaked. Remember, they're inverted. So if you're looking at this chart, this is not a bottom. This is a top. They peaked in October of 2023, so about November of last year, and they've been rising. And gold's pretty much had a bid ever so much since. And then there was some weakness here as when real yields kind of started going up again in the start of the year. And then real yields turned around and gold is back up again. So real yields are slowly moving lower. And I think gold is kind of front running that move. It's saying, okay, like if the Fed's at their tightest point right now, or their most restrictive stance that they're going to be at, and it's only going to get easier from here. That means rate cuts are coming, and gold is a lover of rate cuts. So when rate cuts go down, gold goes up. Now, obviously, there's nothing wrong with owning gold, and I think there's a unique situation as stage three of the compound landing plays out, where you can get a scenario where the Fed is trying to rein in interest rates and achieve this soft landing, bringing real yields down in the process, loosening conditions, right? And therefore, gold gets this bid, but it's not that recession bid. Now, is it going to be that rip your face off bid? I don't think so either. I mean, we've seen this type of price action before in gold where it'll go up, it'll kind of peter out. I think you're going to need like a simultaneous move in bonds with gold to really get that pump that I think all the gold bugs are so desperately waiting for. And I understand. I mean, if we take a look at gold, right? Like, let's even look at the weekly chart. Everyone since 2020 up until November has been pretty much if they bought spot gold has been underwater. That's a long time, right? Like let's go back to 2020. Where have equity markets gone since then? Where's inflation gone since then? Right? Very interesting how like gold isn't really an inflation hedge, it's a deflation hedge.
Yeah, it's
Um,
it's a lot of um, miseducation around that. It really is not an inflation hedge. Stocks are probably the best inflation hedge out there. There's also real estate. I would say real estate is even a better inflation hedge than gold. But
yeah.
we are seeing bonds slightly tick up with gold. Not too much, though. Is this just, would you chalk this up to just price action, or is this something that is also possibly front running a hard landing?
Well, I don't think we have the situation yet where we can kind of point a finger at and say, great, this is like that pivot to stage four. And for those that are new and don't understand what we're talking about, the compound landing is just a dynamic process specific to this rate hiking cycle. It's not very complicated. Simply put, stage three, which is three out of the four stages, assumes that the market's going to try and price in a soft landing to the best of its ability. And in that process of trying to basically where the market's trying to tell everyone, look, it's all okay. The Fed looks at it and says, okay, we can stay more restrictive than we would if the market, if like the underlying indicators were getting weaker. They end up staying overly restrictive, but because of the lags that are built up in their policy actions from their rapid hiking cycle in the last 2 years, they end up overstaying their welcome. And what happens is they sit too high for too long, and they're waiting for things to point them in the right direction. But by the time those things are signaling that the Fed is in fact the winner in the inflation fight, it'll be too late to start cutting. And I think we don't see enough action here in the bond space to really solidify the fact that, look, bonds have put in a trend shift. Now, I do think the lows in bonds are likely in from October. I mean, I don't know. It doesn't make sense that bonds would really revert like this unless something drastic happens. And our views are dynamic, right? So, like, if bonds go back to bearish trend, I'd say, all right, look, we start opening the door. This is how this works. It's like level to level, right? Level to level, day by day. Keep it very, very simple. If we flip back to bearish trend, obviously there's possibility of lower prices. Just like when we flipped to bullish trend in December, there was obviously possibilities of higher prices. Neutral trend is just that, chop. So I think right now we're just going to see this chop in the bond space, which gives less confidence, at least in my opinion, to this gold move. Could we see this gold move fade? Possibly, but I wouldn't. I'm not someone that's going to take conviction behind a move like this in gold without bonds being in basically fueling the sales there and giving me the confidence that the deflation risks, which is where gold propels in, right, are really coming to fruition. So with that said, though, I think we got to talk about equities, right? Because that's just such a big talking point, and everyone's just enraged in a way and confused at the same time, right? The bears are just absolutely pissed about this. And I mean, I understand where they're coming from. Do I understand why they're doing it? No, but I understand where they're coming from. They're looking at any weak data point that gets printed is what they're focusing on. And because they're coming out with a set mindset to find weak data points, it's all they look at. So they think all the data points are weak. And they can't understand why the market's consistently back to back making new all-time highs. They'll tell you things like it's rigged. I put up an interesting X poll this week, and I was just trying to feel out what people were saying. And there was a few individuals that hit the comment section and were like, okay, none of these answers are right. And that's correct. None of the answers are right. The market's not rigged. The reason, and the question was, why is the stock market going up? And one of them was saying there was too many people that are short the market. There's not enough. The market's rigged, and along the lines of that. And the answer is this, and like it's so simple, very simple, but yet so confusing to many, is the market's going up because of one thing. There's more buyers than sellers, right? There's more people buying than there are selling. If it was the other way around, the market would be going down. And that's really all that is to the market going up, right? Like the market is rising because there is more buyers than there are sellers. Just the same reason why Bitcoin is up, and the same reason why oil is not going up is there's not more buyers than there are sellers right now. And you can argue that, oh, supply this, supply that. Well, it's pretty evident by the price. There's not as many buyers as people would like there to be. And we'll talk about oil a little bit later. But long story short, equity markets are trending rather vertically here. I mean, we can take a quick trend line, right?
I mean, we haven't had a dip below mid vamp in a very long time.
Right. So a simple trend line like this, I mean, this is just connecting like a line of best fit, right? And you could see that, like you just said, we haven't even gotten under mid vamp. And I find this very fascinating for one thing. Like, I'm in the camp, look, unless you're under mid vamp, base case scenario, new all-time highs are on the table every single market session. That should be your base expectation. So when I get the alert, new S&P 500, new all-time highs, I'm not surprised, especially when price is holding mid vamp, because what that's telling you is, number one, you're in a bullish trend. So your trend is defined. Price action is up, right? That's defined by the trend. Then what the mid vamp does is basically tell you where short-term price momentum is. So when you're above mid vamp, now you're not only you're in a bullish trend, but you got strong short-term price momentum. So it's literally all the stars are aligned. So why you wouldn't expect all-time highs is not, it doesn't make sense. Now, If we were under mid vamp, I'd say, okay, look, we can consolidate. But when you're above mid vamp, it's pretty simple. New all time highs just on repeat until it doesn't work. And at that point, we could it be at 5,300? Could it be at 5,400? Could it be at 5,280? Could it be in the next week? We'll find that out. But again, base cases, right? You have to start somewhere, ground zero, and work your way up. So until I'm proven wrong with price action, I expect continuous all time highs.
It almost feels like a game of musical chairs. Every time the market starts dipping, VIX seems to explode. It's like everyone
That's very
jumps on the
fascinating. I
hedges
know.
as
I
soon as
know.
there's a dip, even if it's a very insignificant dip, like we saw today. We had a red day today on Friday, and the VIX shot up and actually never even fully recovered. So going into next week, we're going to have a slightly elevated VIX. It's as if so many people are expecting the market to just crack at any moment and are just jumping on hedges as soon as they see any sign of it possibly happening.
Right. Now that's a good point that you made, right? So let's take a look at VIX. VIX is at 1473 as of we're recording this, right, into the close on Friday. In December, it hit a low of 1181. This is spot, right? This is not a futures contract. Now, let's go to ES for a second. So as you can see, we've been rising. And if we go back to ES has been rising too. So what's going on here? Why is spot vol drifting up and equities aren't like breaking down? Typically, this is seen where like when people say spot up, vol up, they're like, oh, like it's getting frothy and it's going to blow up. And that's not really what I'm seeing. What I'm seeing is this. We saw this on February 13th. We're seeing this somewhat now, not as pronounced as it was in February, right? Where we didn't like if we look at the future, we'll even go to the S&P 500 ETF because this is like we take a lot of the futures noise out of it. We were down 60 basis points on Friday. 60 basis points. We are not even below Thursday's trading range. We are not even at the lows of the week. Okay? We're not at the lows of the week, but VIX at one point today printed its highest print since February 21st of 2024, so last month. Think about that. VIX is going up at such a rapid pace at these minor price declines, and what that's telling you is, like you just said already, people are looking at the market and saying, oh, like top, that's it, time to buy puts because I got a top ticket. And what ends up happening is there's just a perpetual demand for protection, which doesn't make sense. Now, there's another argument that's made where it's saying like, oh, the skew shifted where like up day volatility versus down day volatility is more severe. And the argument for that is like, oh, like we don't go down nearly as volatile as we do rip, and that's not an argument. If anything, that's extremely bullish, if you ask me. Right now, if the up days are more powerful than the down days, you can't really overcomplicate that. It's very simple, right? What that means. But you have to look at the whole picture here. The S&P 500 is not even under mid vamp, and we already blew almost a 16 VIX spot on Friday. So what that's telling you is and this has been something that I've been talking about on X for probably the last month and a half at this point, where everyone's piling into these shorts real quick. And the resolution for this, which most people don't like to hear, is new all-time highs. And what happens in that process is VIX gets the washout and then it rotates back up again. And we're noticing that at least as of Friday, these blow-offs are getting smaller and smaller. Ideally, if you're bearish on the market, for whatever reason, you think the market's going to implode, right? Or at least for me, for some sort of like severe dip scenario where even go back to October of 2023 where we got a nice drawdown, like a very strong drawdown. We can even look at VIX back then, right? October 2023, like we saw VIX basing down here at 12 and actually coming in before that. Like it tried to go lower, failed, and blew up right into October of 23. Like we're not even seeing that. So if I was bearish, I would try and see if we can get a hedge washout here, wash out a lot of these hedges with a real vol move, a real vol suppressive move lower, where we squeeze out a lot of people, where it almost it almost feel like the market is going straight up. And now you might say, oh, the market's straight up. Yeah, the market's straight up, but like not really, because if we go back to February 23rd, right? Like let's go to February 23rd, we're only up 48 basis points, right? Let's go to the highs of February, the highs of February, of early February, or we'll go to the highs of January, right? The highs of January, we're up 4%. So it sounds like a lot, right? But it's not this vertical nature that everyone's making it out to seem. It's not like the stock market's
Yeah,
actually gone
I think we
vertical.
need something like we saw in 2018 on Volmageddon. I think we
Let's go
need.
back there. Let's go back there. Where that was here, right? Like that did no, that's
No, it
2020.
wasn't that
Excuse me.
right
It
there.
was
I
here.
I
Yeah,
think
like
we really need
this.
to go vertical like that to basically everyone that's shorting to question their life and decide that okay, maybe it's time for me to stop hedging and stop shorting, and that's when we're opening the door to an actual pullback. I
Right.
think
And I
that's what
mean,
we need to see.
it's funny you say that because like I don't know if we're gonna get to that magnitude, but I do agree with you. Like we need something to shake out these hedges because obviously, like I don't number one. I mean, look, you want to hedge, I understand, but the way they jump on these hedges on just the slightest red day, crazy,
Yeah,
crazy.
and the market doesn't crash when everyone's prepared for it.
Yeah, yeah, I know. Like, and the counter argument to that is, well, look, the S&P 500 moved 60 basis points today. VIX should be elevated. We're moving a percent a day, right? We're like the ranges, like we're talking about ranges, right? The ranges are quite wide, 100 basis points, like they're not wide. So that my answer is we check out our realized volatility, right? Check out realized volatility. Realized volatility is about 11. Okay, for today, 11. VIX is up at 14. There's fear here. This is not just normal price action. There is fear in the market that I think needs to get washed out. And remember, this is realized vol. So VIX is implied going forward. This is what has happened, right? So like the market's obviously not as volatile as what VIX is telling you it is, and it hasn't even been this entire time. The highest R vol reading we have here is probably 13 and a half. While VIX, if we take a look at VIX, I mean, VIX went in the last was almost at 18. So it's obvious that the market is overreactive right now, and I think that that's what's pissing a lot of people off. And they get very hyper aggressive. I mean, let's just run over Bitcoin, right? Like in the last week, we went for the all-time high push on Monday. What a push! What a dump in one day, right? Absolute carnage, and it went actually quite interestingly right down to mid vamp and reverse. But that dump automatically the X feed bearish engulfing. It's so fucking over, dude. Like it's just every possible and today, right? Nvidia. I know this one. Bearish engulfing. It's so over. Nvidia is down another 2% after hours. Oh my god, people are breaking down. Could Nvidia pull back? Yeah. The key sign for you here is Nvidia is down 5%, right? And then another 2.45% or almost 6% to regular hours and another 2.5 and after hours. And SPY is not under mid vamp. Think about that for a second. Nvidia is down almost 10%. And so what is that telling you? Why is that important? Nvidia is down almost 10%. It's telling you that this is not a market just around Nvidia. It's not. As much as these
So
people want to
that whole
isolate
breadth
this,
argument basically goes out the window. That was
right?
another bearish case. Oh, the whole market is going up because of these 5 or 6 stocks. That
Let me
basically
just show
went
you.
out the entire window.
Do you know what this is? This is equal. I mean, obviously we know what this is, right? This is the equal weight S&P, right? For those that don't know, this is an S&P ETF that doesn't market cap weight, so Nvidia should not have as big of an influence in this ETF as it would in SPY, where it's heavily weighted or more heavily weighted. Um, but not even Nvidia, the Mag 7 as a whole, right? Take a look. This is up. Like this is not just one stock, and this is not just 7 stocks doing this. So when you look at this and you try and dissect the bear thesis, and I want to hone back to what we've been saying, right? Where we've been coming from this entire time, where we say your base case should be bullish, and that's not meant to be like an idiotic stance of just saying, look, man, we're just going to throw money at the wall, see if it sticks. Who cares? Market will return. There's people like that say, buy, doesn't matter what price you buy, in 10 years it'll be higher type of thing. And that's not what we're saying. We're saying you have to lean. if you were standing in the center, you should lean towards being bullish and then let the bearish things pull you over the line. Don't just be standing in bearish territory 24/7 and just saying, "Oh, it's the end. This is it. This is it. This, it's all over. Like, this is the market's manipulated. It's not real." That's not a very good place to be in. And it's, quite frankly, you end up being wrong a lot more than you are right, and you end up sitting on the sidelines all the time. And maybe then one day you do get converted and you're like, you know what? It makes sense to buy, and you actually buy the top because you've been too complacent for too long.
Yeah,
And
and I
that's
mean, another word of advice I would give that I've just seen so much lately is just being angry at the other side. So if you're bearish, you have just you're sidelined or you're short, and you're just angry that the market continues to go up, and you're angry that you're wrong. It goes the other way too. You could be long and the market's going down, just like we saw in 2022. There was a lot of bullish people that were angry that the market's going down, and you can't be like that. You can't be angry. Sometimes you're just wrong, and you have to admit that you're wrong. There's nothing else to it. We have been wrong before. We will be wrong again in the future. But at the end of the day, we do have a system that tells us what to do. We do not trade based off of emotion. So we don't get angry when we're wrong. It's just, okay, the system is just wrong this time. That it happens. It's not perfect. Otherwise, we'd be incredibly wealthy.
very fast, right?
Yeah,
It'll be
very
a very,
quickly. But
yeah.
it's going to be wrong at times, and we won't be mad about it. We have the back test, we have the results. We know it works in the long run. It's not going to get everything perfect. We just take the L and move on, and the next one's going to be a winner. That's it.
Yeah.
You
Yeah.
can't
And
you can't just always be emotional and be sidelined and be angry that the market's going up. If you trade like that, you invest like that, it's just a losing game.
right. And I think I want to wrap up this podcast on the final topic here that's been floating around X, and it's just the Federal Reserve, because obviously everyone is very, very heated on the remarks Powell made this week. They're very, I call them, we'll call them sensitive macro tourists, if you will, right? The macro pilled community, what we call them, but you can even call them a step further. They're the sensitive macro tourists. They don't know much, and they come to the table and they say, okay, Powell said he's going to start cutting rates before they get to inflation 2% target. Oop, that means inflation 2% target is no longer 2%. No, the answer that is actually incorrect. Okay. The reason why the Fed has to wait, the reason why the Fed cannot wait until inflation is at 2% is for one reason. If they wait, by the time inflation gets 2%, inflation will have such a lead on them that they'll be in a position that where most likely than not, they're going to be panic cutting. And they do not want to do that. That's not a soft landing anymore. That becomes the recession. Now, is a recession easier for the Fed to deal with? To a degree, yes. But if they know they're in a position right now where they can quote unquote thread the needle for that soft landing, which is stage 3. But you can already see it between the Fed members in their public speeches. They're very torn between if they should cut. The economy is doing good, maybe we shouldn't cut. So they themselves are debating their own lag in policy. And I have a chart pulled up here, but if you guys are listening, you guys can't see this, I'll make it real simple. The Fed right now is pretty much near peak restrictiveness. Okay. They are not in easing territory, no matter what people want to say. They are quite well above the baseline and into restrictive territory. What's going to happen here is if the Fed does absolutely nothing and waits for that inflation target to be met, inflation's going to drop, but policy is not. So if you could imagine a spread with inflation, with policy above inflation, imagine policy dropping, right? Just falling, but inflation falling, excuse me, but policy's stuck still, right? What happens is that gap widens, and that level of restrictiveness just automatically grows on the economy and becomes more compounding on it. Basically compounds on itself. And that's something that the Fed is aware of, but they don't know how fast that inflation factor is going to drop. So they're very hesitant on bringing those rates down. And they don't want to go too fast because the last thing they want to do is actually have to hike rates again. But the Fed is restrictive, and the Fed should in fact be cutting interest rates well before inflation gets down to target, even if it's just a cut every other meeting, just to get the ball moving instead of just sitting there, right? So people are saying, oh, look, commodities are going to go up, um, oil's going to rip. We're not seeing any signs of that, and that's where I'll finish this off on this podcast. But I mean, look at oil. Like we always say, follow the trend. The trend's bearish. If you want to claim oil is going to go up, at least have a bullish trend on the charts here. At least have more buyers than sellers in the market. We're not seeing that. And if anything, if oil holds up under mid-vamp, the doors are open to 75. And then even bearish trends tend to lead to lower prices, right? We could see new lows. That would be extremely negative for inflationary expectations, therefore accelerating that decay or that accelerating those restrictive policy effects of the Fed, therefore having to push up rate cuts if we were to see something like that. So keep your eyes out for that. But I think that's where we're going to wrap up the podcast today, guys. Thank you so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar or go to our website, market-radar.com. You can sign up for our free newsletter. We send it out every Sunday, and you can also get access to the free portion of our Discord. Thank you so much, guys, and have a great week.